Boy, what a week we had last week. Big correction to the downside. If you were following along with the shorts, then maybe you caught some good trades to the downside, made a little bit of money last week. And then on Thursday, we got the bounce. So that's where my buy the dipper stepped in, started buying up the market. SpaceX trade came in on Friday. Market continued on up. So this week's a brand new week. Got a lot of big events happening. So we're going to jump right on in and see what we got going on this week. I'm the Wall Street Yardie, and this is your weekly market report. Jumping right on in, we got only two things we're paying attention to this week. We got a big macro event with the Fed meeting happening Tuesday and the announcement of the Fed rate policy on Wednesday. We're going to talk about that. We're going to also talk about a couple other things that in the macro we need to be paying attention to that could affect the market and the swing that we're looking at. Then we're going to jump on the chart and I'm going to show you some levels that we need to be paying attention to. And if price breaks above or below those, we need to really be paying very close attention to what's going to happen in the market after that. All right, first things first. We're going to pay attention to what the Bank of Japan does on Tuesday. They're going to announce their rate decision on Tuesday, whether they're hiking or lowering their rates and what's going to happen to their interest rate. The reason we care about this is the Japanese yen carry trade. You might have heard of this, you might not, is really a currency and interest rate trade where investors borrow cheaply in Japan and then they invest in places where they can get a higher rate, like the U.S. If Japan raises their rates, this trade becomes less profitable. Investors start to repay the Japanese loans that they take out to make this trade happen. The bonds in the US are usually the most direct target, but the yen carry trade, if it starts to unwind or undo itself, investors will sell US assets. They'll convert those dollars back into yen. Dollars come out the US market, stocks go down. That pulls investment capital out of the US and the bonds, and then it increases demand for the yen, which also then weakens the dollar. So if the dollar gets weak, imported goods become more and more expensive. And guess what? The inflation that we heard about last week with CPI and PPI, it gets a lot worse. So now then our Fed has to do something to react to that. So to put things into context about the yen carry trade, the Forex market trades about $10 trillion a day. It's the largest market to trade. And the yen is involved about 17% of that trade. So it's a very large number where Japanese yen is moving throughout the world into different currencies. A big part of that, of course, is trading yen into US currencies. That's why this yen carry trade is such a big deal and why we want to pay attention to it on Tuesday. Typically, we compare the 2-year bond rates between the two, the US rate and the Japanese rate. This is what is usually affected when the Fed announces their rate changes. So that's why we pay attention to the 2-year rate. Currently, the Bank of Japan 2-year bond rate is about 1.41%, right? So we're looking at a very low rate there. And then the US rate is somewhere around 4.09%. So now you have a spread of about 2.6, 2.7%. This is where the investors in Japan are borrowing cheaply and then using that money and investing it in US treasuries and then getting a bigger pie or bigger return on their money as they come over to the US. So they're looking at a 3% return, almost guaranteed, because the US Treasury has never defaulted. So they feel comfortable. They feel safe in that trade. It's a very low risk trade for them. It's easy money. It's free money. But if the Bank of Japan raises their rate, this 2.6% spread is no longer maybe as attractive to them. And then they need to go back and pay off the loans they did to borrow the bonds initially. So we're going to pay very close attention on Tuesday and Wednesday. Tuesday, the Bank of Japan decision, and then Wednesday we have our Fed rate decision, and we're going to pay very, very close to that. So as we go through the week, there's really not much earnings we're paying attention to, so we're not going to jump into the earnings. There's also a couple other Reserve Bank announcements that are coming out, Bank of England, Australia, and then also the Swiss Bank. These are all the other currencies that make up the Forex trade. I don't really talk about the Forex market, but it does affect how money is flowing through the different markets around the world, especially when it comes to the yen in the US, where, you know, that trade is a very big deal. And if money start getting pulled out of the US market because Japanese raises their rates, then we could see our markets drop because those guys need to go and pay off their yen loans. And to do that, they're going to take money out the market and return it back to Japan. And then that currency and the dollar exchange really makes it worse for the US market, especially when it comes to inflation. And now the Fed, instead of pausing, they might have to raise rates, which makes it harder for US companies to then borrow money. So if they can't borrow money to grow, then things either stay stagnant or worse, we start to fall into a recession type situation. So we're going to pay attention to that. And then lastly for this week, we don't really want to pay attention to retail sales and then the initial jobless claims, because this is going to then tell us how healthy the US market truly is. If you've been enjoying the content on the channel so far, please give me a like, give me a subscribe, It's going to build up the channel a little more. I'd appreciate that. I got a huge generational wealth video coming out for you tomorrow. So please pay attention to that. So mash the notification button so you know when that goes live, and you'll be ready to see what's going on there. And lastly, link me in the comments, man, because I'd love to have a little chat with you guys and see what's going on. It also helps build up the algorithm a little bit more on the channel as well. So let's jump right on over into the charts. All right, here we go on the charts now. So last week, as I mentioned in the intro, we had this nice big pullback here on Monday. We saw, after big Friday drop, almost 3%. Actually, we dipped kind of down to almost 3%, then pulled back to 2.5%. But then on Monday, that weakness just kind of followed. We opened not even at the middle of this big red candle from that previous Friday, but we were, just below that. And then we closed very low. This is where I dropped the first little short, telling everybody to prepare for Tuesday to be bloody. It certainly was. Wednesday then followed being even bloodier. Now, look where this fell right onto. So we've been watching these levels for a long time. Remember, if we go back here on the chart, you see we have this gap here. I've been talking about gaps this entire time. Every time I do the market report, when I see one, I call it out, let you know, because gaps is support and resistance. Support and resistance, when you're trading technically on a chart, support and resistance is the main thing you're going to pay attention to. A lot of people call them demand zones or floors or ceilings or whatever you want to call them. This is the place where the action happens, right? The support and resistance levels, that's where it happens. So anytime you see a gap, price likes to come back and fill those gaps. So we had this gap here right around 725. Price came back, filled the gap on this big down move, right? So we got this high, pivoted lower, all the way back down. So price always likes to be attracted to support and resistance. We can identify it. The big problem with this big move up is as we were going up, there really wasn't any major pullback. We had a very small one here, and we're going to talk about this level in a second, but this was just, 3 little candles, and then we continued on up. So it wasn't really enough to, call it a true pullback. This one here that we got last week was the one we're paying attention to. So this was our level. This level now at 725 has really proven itself as a place where we need to pay very, very close attention to. Now, if this week we get some crazy stuff with the Japanese yen trade, and Bank of Japan raises their rates, or even our Fed has to raise their rates, then you can see probably price will come down. And if it closes below this 725, look out below. We're probably going to head all the way down to 700. But look right here in this range of 710, you have some support area here as well. It's very minor. It hasn't proven itself yet because we only hung out there for a couple days. So there's not, and there wasn't a lot of volume. If we look down here, there wasn't a lot of volume there. So we can very much blow right past that. If we close below 725, I suspect we will blow right past that, right down to 700. This will be our next level of support. Maybe that's where, if you're a buy the dipper, that's where you probably look to see if we get the bounce at this 700 level. If we do break down there, the bounce would be here. Okay. I wouldn't try to buy the dip anywhere in between here. I would be looking at buying the dip at 700 if there's going to be a dip to buy. And then if we go to the upside, on the opposite side, if things come out good, the yen trade stands up, the Fed doesn't have to raise rates, or maybe indicates that they might want to lower rates, then our upside is somewhere here 766. That's a little bit less likely to happen. I'm gonna show you why. So if I turn on my moving averages here, my 20-day moving average is this curved yellow line, if you will. And as we broke down last week, we came down to our support level. Support, the opposite of support is resistance. Support is going to be the level below the current price. So, as we were up here, the level below the current price was 725. We got there, found the support. Resistance, on the other hand, is the current support or resistance level above current price. So right now, turn on my moving averages, I see that, one, this moving average is starting to slope down. Two, after this big pullback down, and the bounce, we didn't get back above the 20. So we didn't get it back above this line. So we have to prove that we can close above this 20-day moving average before we even think about going to 766. So that's one thing to watch out for there. The other thing on the downside is this 50-day moving average. So we need to hold this as well. So if we break and we close below the 50-day moving average, this is my orange line here, or the 725, and we close below that, look out below. We're going to 700. That's going to be my call for for the move if that happens. So the other thing I'm paying attention to, I've been talking about this for a few weeks now. The volume on the SPY in the overall market is a little bit scary to me. If you look back in history, we were trading upwards here of 79 million, 80 million shares every day, 100 million even on the peak here on this buy to run things up, and then it just kind of fell off, and it fell off in a very big way to where you can actually see the slope. This little orange line down here is my average, moving average actually on the volume. And you can see it just fell down and flattened out. We started to go back up, but when volume starts to go back up and price is pulling down, that's a very bearish sign. So we're going to pay very close attention to this because volume only started to increase when price was coming down. It wasn't increasing as price was going up. So this gives me a very big lean to the downside. And we're just going to watch a 725 level, moving average level, which will probably get up here on Monday anyway. So we're going to pay very close attention to that. On Tuesday, if that Bank of Japan trade doesn't play out, we could see us close below this level. And then Wednesday, I don't know if the Fed is going to be able to tell us anything good, given all the inflation news that we have from last week. So we're going to pay very close attention there. I'm leaning to the downside here. The trigger is this 725 level. If we break and close below that, then we're looking at the 700 level. So that might be a trade if you're a short-term trader. That's what you're looking for. If you're a buy the dipper, long-term investor, then if that breaks and the dip happens, then we're looking at 700 as your place where you might want to buy your next tranche or buy your next investment. So that's what we're looking at here, and that's the moving average. Now the other thing that gives me a little bit of pause as I'm looking at the chart here is also the VIX. So we talked about the VIX throughout the week last week as well, but the gap on the VIX still hasn't filled. So I'm expecting if we do get that break to the downside, we're going to come up, fill this gap, and that's where we're going to want to pay attention to is, does that get us down to the 700 level, wherever it might be, and then does the VIX start to reverse? And if that's the case, that is truly the confirmation for you buy the dippers out there. When VIX starts to reverse after filling that gap, then we're going to have a nice potential upside. So going back to the SPY now, let's talk a little bit about market structure and the other reason why I might be a little bit bearish going into this move here this week. Last week we had a lot of excitement around the SpaceX trade. There was a lot of chatter around Iran. Right now we're supposed to get a nice Iran deal here at the beginning of this week, so we'll see if that happens or not. We've been waiting on that for a while now. It's kind of hard to try to trade around it because of the ups and downs of how that news has been coming in and out. So what we're going to pay attention to, though, here's the lesson of the week, is that when we had this big pullback here, we did go below the low right here. So whenever we're looking at a chart and chart structure, we want to look at the swing highs and the swing lows, right? So a swing high is when we get to the top of price, and then we start to get a candle that has a lower high, right? So the high on this red candle is lower than the high on this green candle. So that's where we start to get our pivot, okay? So we have the lower high in conjunction with a lower low. So the low on this candle is also lower than the low on this candle. So lower high, lower low, that's when we can then identify our swing high. The swing low is just the opposite, right? So the next candle over has a higher low and a higher high. So this is where we're swinging back up, okay? So these are your swings, most recent swings. This one's a little bit smaller. It was only, 3 candles. So, it doesn't necessarily carry as much weight as maybe the swing low if you go back to April here, where we had a lot of candles to the upside, right? So this was our big run up. So this was a big swing. With the swings, this is where we like to put our Fibonacci anchors, if you will, right? So when putting a Fibonacci on, we're going to use this point here and we're going to use this point here because this is where we started turning lower. Now, what I'm noticing is that we have this swing low here from the 19th, and now we've broken that. Now we found some support here at the 725, but we're bouncing up. And with the moving averages, I showed you that we have, resistance here with the 20-day moving average. So this could be a level we got to watch out for because this candle is not very bullish. It's a doji candle, small body, long wicks. This is a place of indecision. So we're going to find out. Monday is probably going to be another doji, to be honest, because we're going to be waiting for that Japanese Bank of Japan decision. And then Wednesday, we got our U.S. Fed rate decision, right? So two big events back to back. And then, we have indecision on Friday. So we might have some indecision tomorrow. Might be a small trading day tomorrow on Monday, June 15th. So we're going to pay very close attention to what happens on Monday and then watch the news for what happens with Japan on Tuesday. But being that we broke this swing low, back to my point, is that, this is now the start of potentially a downtrend because now we have a lower low from here. So we now have a lower low. Now, if we form a lower high, that is when the trend has now shifted to the downside. So what I'm saying to you is if you start to see candles from this pivot now, because we came down and we bounced up. Now we're bouncing up. We're creating, higher high, higher low off these two candles. If we now start to see a lower high and a lower low here, right, somewhere Monday, Tuesday, whatever, then you can almost feel good about taking a trade to the downside. So maybe you buy some puts. If you're just investing long, you might want to figure out how to maybe take some position off or, look for that next bounce if you're buying the dip so that you can dollar cost average it. So lots of strategies there, right? So I'm not giving you financial advice. You have to know kind of what your strategy is and what you're trading and how you're trading. A lot of you are trading very differently than I do. So I just wanted to give you the levels and pay attention. But if we get a lower high and a lower low here, right? We now have a new pivot here, or maybe it's on Monday or Tuesday, where we could say this pivot now has a lower high and a lower low. We already have the lower low here from last week than we have. So the uptrend has now paused at least and started to reverse to the downside, which would then give me very good confidence that we're going down to 700. So that's how you read the market structure. You have to find the swing levels. This one is a swing level, but it's kind of weak because it's only a few candles. But we have to take it there. This is not a swing here because, as you can see, candles are going kind of sideways. There's just a lot of indecision right here. We didn't get a good V, right? One way to look at that is on the trading view. You could switch to your line chart. Maybe you can switch to the line chart on Robinhood as well. And you'll see that there really isn't a good clean V here. If you look here, remember this was our pivot back in March, April. Nice little V here to the upside. Nice little V here last week as we got down to 725. And this one is a little choppier V at the top, but you see it gave us two big Vs and then we came on down, right? This was another one, a nice big V here. So this was the smaller swing that we came down to here. So if you flip to the line chart, you might be able to see the pivot points a lot easier. That's a great way to do it. You can then use that to put your horizontal lines on the chart as well. So that's a nice little tip there if you're doing some charting. But these match up to the lows and the highs on the chart here. So that's what we're watching for. So we're going to pay attention. Are we going to form a lower high here? If we do form a lower high here, then I think we're going to head on right down to 700. We have to break this 725 because there is pretty good strong support here. So far, so good. It's a gap level. So we're going to count this as an area, 1 touch, 2 touch, 3 touch, 4, right? So now we got to see, we got to close below this level before we can feel good about 700. But if we do break down, that's what we're looking at. So that's how I'm feeling. I think, this week might be a little bearish, depending on what's happening with the Fed here. That might last through the summer. Oil prices are still high. They're still at 90, right? So we need to get that Strait of Hormuz open. So that's what we're going to be paying attention to. Give you a nice little market structure instruction there. So hopefully that was useful. I'm the Wall Street Yardie. Link me in the comments. Catch you next week.